So once again, the two definitions that we play by here are the investment definition from Graham and Dodd in their 1934 book, Security Analysis, and Jesse Livermore's definition of what speculation is. And so let's talk for a second about what those definitions say. So the investment definition is the following. An investment operation is one in which, upon thorough analysis, provides safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Okay? And then there is the speculation definition, and that says the object of a speculator is not to secure a steady return on his money at a good rate of interest, but to profit by either a rise or a fall in the price of whatever he may be speculating in. And so you see how those differ very boldly. It's a big difference between what investment and what speculation is. So then we ask ourselves the question, does life insurance provide safety of principal? Because that was the first part of the definition of investment. Well, the short answer is it depends. So the money that goes into the cash value of a permanent life insurance policy, and like I said, that's the genesis of this whole question. The money that goes into a permanent life insurance policy, it is yours. But in almost all cases, if you are to die, your beneficiaries only receive the death benefit. And that's an issue because that means the safety of principal was not there in the money that you thought you were investing. That means that what you thought was an investment, in fact, was not an investment. It was just some money that you were laying aside, and it was lost in the shuffle. So that's not always the case, but in mostly all of the permanent life insurance policies, that is the case. And in such cases, the extra premiums that you paid to put money into that cash value were really all for naught. And you may say, well, Dylan, I can pull the cash value out before I die, and then it looks like an investment to me. I made money on it, and I take the money out, and now the money's mine. But how do you know when you're going to die? How do you know when it's the right time to take that money out? The problem is you don't. And if you knew, then that would make perfect sense. But the fact that you could die today, all of us could die today, there would be no way to get that money out. And that is an issue. And let's not forget that life insurance policies thrive on premiums. So let's say that you don't have an auto draft for your premium and you make your premiums on your own schedule. And let's say somehow you fail to make a premium payment. Well, that can be a big issue. And why that could be is because fail to pay your premium can void your policy. And so you can lose everything that you had there in that built up in that cash value if you don't pay your premiums. So again, safety of principal is extremely questionable here. It can be the case, but it doesn't look really promising. Then we ask, does life insurance offer a satisfactory return? And because that's the second part of the investment definition. Well, no, that's emphatic no. And here's why. Because even with permanent insurance policies that are variable or have indexed options, right? So being indexed means like following the S&P 500, or being variable, meaning being put into different funds like mutual funds and things like that. Even though that can be done, not arguing that here, the fees are crazy. And the problem in these particular types of accounts is that you are making the insurance company money that you don't have to be paying to them. So if you want to invest money in an index fund, it's almost costless, and it is costless at some companies. So why would you pay to be indexed to anything? Doesn't make sense. It absolutely doesn't make sense. Or why would you pay fees for a variable life insurance policy when you can just put your money in the mutual funds you want to put them in and allow it to be variable on its own? And another issue with this is that a lot of these policies only allow you to get a percentage of the returns of an index if you're indexed, or a percentage of the returns if you're variable. And that's a big issue too, because if you're investing, you want to get all the net returns you can. And so if they are capping your returns, that's what that's called, capping your returns. So if they're capping your returns and taking pretty substantial fees, then those things together eat at net returns more than anything. And that's going to be a problem for you long term. And so it is not going to provide you a satisfactory return for an equal amount of risk that you would be taking. And then basic cash value policies that are not variable or indexed, are trash rate of returns. And so there's really, really, really no reason to think of that as an investment, because it absolutely is not offering a satisfactory return to you. So, what makes life insurance, and specifically permanent life insurance, not an investment? Well, let's think back to the couple of things we said. Safety of principal, not sold. So, first, there's too much ambiguity as to whether you're going to get your cash value back or not. And I really hate that. I want you to be able to get the money that you need from your investments. And I want your beneficiaries and the people who are left behind you to be able to get their hands on the money that you leave behind, and not just allow that money to go down the drain in a cash value life insurance policy like it typically does. And then returns are subpar at best. And we just talked about that. The biggest issue here is after fees. I mean, net returns are going to get eaten away by the fact that you're paying exorbitant fees for the ability to be indexed, or for the ability to have a variable portion to this life insurance policy. And that's too much for the exact same thing you can get for almost free, if not free, if you're indexing. And so let investments be investments. And a good way to tell that something is not is if it says insurance policy on it. And so just make sure that that's the case. It's just really, really hard to justify having something that you're pouring money into that is not guaranteed to give the money back to you. And so that issue is the primary reason why I say this is not an investment. And it's really hard for me to talk this way, especially about life insurance, because life insurance is not bad in and of itself, but these particular types of life insurance that I've really kind of harped on today, they can have really tough implications relative to other things that you could be doing, that it's not worth your time. It's not worth throwing your money away to have this thing and to have this particular type of insurance policy that are so heavily sold. They're sold to everybody with a pulse and a social security number. They get out there and they try to sell these life insurance policies, and they're not out there pushing term. They're out there pushing whole life. And the reason that they are, just for your information, the fees. They make more money on these whole life insurance policies, just period. And so be smarter with your money. Do things that are investing with your money. And insurance policies just aren't that.